Okay, I am stuck in traffic and there's not much else to do but deliberate about markets. So I did a bit of a market sort of checkup today, and I was obviously wondering where we are in regards to this bear market. If the bear market if there's any signs of it stopping. So I'm going to just go through a couple of things that I have found that might give us some indication if this market is going to stop going down, if there's actually a turnaround at any point. Obviously, it's got a bit of a drop now, but it's all actually still in the same pattern. We haven't broken pattern yet, so we're still technically still in the bear market. Even if it turns around now today and it jumps up a bit, it has to jump up above certain lines before I would say that we're breaking pattern and then we might be back to a bull market. But at the moment, we are still following the pattern. So if you use some technical analysis on the S&P, the Nasdaq, the Dow Jones, the whatever, you'll still see we are in the pattern. So we're still technically in a bear market, but I'm looking for indications to see sort of how long it would be until there's a change. So some of the charts I've looked at is first of all is obviously the 10-year Treasury bond. That's basically just signaling how much faith investors has in America for the next 10 years. And the higher the price or the higher the returns, the yield, they can just call it the 10-year Treasury yield. The higher the yield on 10-year Treasuries, it means the cheaper the price. So a high yield is actually not a good thing. It just means that there's not a lot of faith in people. People won't buy the bond, or there's just other more stable ways of getting a return higher than at the moment. It's sitting at 3.1%. We did briefly touch 3.5, which is quite high for the 10-year Treasury if you look at the last 3 to 4 years. So that's not a good sign. That still signals that we are pretty much in a bear market. Now the next ones I've looked at is the 30-year average mortgage rate. So at the moment we are sitting on above 5.5, almost 6. And that's really high. That's the highest it's been in also like 5 or 6 years. I don't think if we've been that high in maybe 20 years or so. So that basically means that it's quite expensive to buy a house at the moment, because the house prices, as you know, it's just soaring like crazy, and the interest rate is high. So it's just ridiculously costly at the moment. So what you would pay for a house now versus 2 years ago, your actual monthly rate you pay is probably going to be double versus 2 years back or 3 years back. So there's no way people are going to be able to afford houses now. The housing market is definitely still in for a dip. It can't be sustained how it is now. And if the housing market dip, it usually means that a lot of industries around that, from the construction industry to some raw materials like wood, etc., would also be impacted. So I don't see a upturn there. It's still definitely, it's set up for a downwards turn, not an upwards turn. And then there's the copper price. Copper price is an interesting one. A copper price sort of gives you a world view of where the world economy is heading. And if you look at the copper price is down. The copper price is a good indicator of, because so many components and so many things need copper, it's an idea of what the demand for copper is. And it just basically signals that globally there's not a lot of new things being built that needs copper. So that definitely means that globally there's not a big demand for goods that involves copper, which is obviously bad. If there's no demand, it means the economy is basically not going to be as hot. So that's a very nice leading indicator to sort of a worldview of where things are going. So worldwide, if copper price goes down, it means worldwide demand's down. That's not good for the American stock market either. And then there's the Warren Buffett indicator. So the Warren Buffett indicator is sort of it's not extremely reliable in predicting recessions, but it has been used a couple of times to sort of see when things are getting a little bit iffy, when we are on the verge of a bit of a financial downturn. And if you look at where it is right now, even after the dip we've had, obviously it's been at its highest. It was sitting at 200% recently, which is ridiculously high. The previous peak was like at 160, 170, around about there. And we've only come down till the previous peak. So we're still ridiculously high when it comes to the Warren Buffett indicator. So I'm not very optimistic about a bull market purely if we look at that. Obviously that includes a lot of the things we've discussed. So yeah, and then I'll find a bit of a gap here. I need to get into this lane, but it's chock and block. There's a gap. Nope, it's closing. The next thing we can look at is the GDP. The GDP is starting to flatline. I don't see a spike in GDP coming anytime soon. So the GDP obviously is what determines a recession. So if we have any negative GDP numbers for two quarters, then technically we are in a recession. We haven't gotten those numbers yet, but I'm pretty sure if you just look at the general curve of the GDP, it's definitely on its way down, or it's changing. It's trending to a place where it might go down. The next thing is the M2 money supply. So the M2 money supply, that's basically how much money is in the consumer's hands ready to be spent. And because of obviously all these stimmy checks for the last 2 years, it's just grown to insane amounts. It's grown to $21.8 trillion, and it's stopping now. So there's no more. You can definitely see there's not a lot of money entering the economy anymore. Now it's literally just sort of staying there. It's not growing. It's flatlining a bit, so I'll be interested to see what that looks like in the next report. The next report will be we're not there yet. Okay, I think it'll be soon. We'll know the new number. That'll be interesting. And then another thing I'm looking at is margin accounts. So margin accounts is an interesting thing. Margin accounts is almost like a throwing wood on a fire. If the fire is not lit and there's a lot of wood on it, doesn't really matter. But if there's a lot of wood on a fire and then you light it, then the amount of wood matters. So that's sort of how I see margin accounts. So margin accounts, the higher margin accounts, these are margin accounts for the stock market basically. So people actually opening margin accounts to trade with. And margin accounts is still at an all-time high. It's still ridiculously high. So I'm just going to cut in here. It's still insanely high, which means there's a lot of wood on the fire. And the thing with margin accounts is if we do get a bit of a dip in the stock market, obviously this is going to cause margin calls to happen, which means there's going to be a lot of people that don't have a choice but to close their positions, because the brokerages are going to close their positions for them. And the knock-on effect of that is that the stock market is going to drop further because there's more positions that are closing. So yeah, that's not a good thing. There's a lot of wood on this fire. Another interesting one is the repo rate. So the repo rate usually happens when the balance, the repo rate starts going up if the balance of money is getting better, but it's still on zero, which means that there's still too much money in the system, because banks don't really want money, they want assets. So, and when they need money, then they use the repo rate to borrow money. But the repo rate is still on 0, which means that the banks are not, they're not actually at a happy place where they can say, cool, I've got enough assets, I have sort of almost no money, or I'm back basically on the, what is that, the sort of the margins that they have to play along with, that's set by government. How much reserves? Yes, they're not hitting their reserves yet. They've more cash than their reserves, or than their reserve specification set by government, which means that there's technically still too much money in the system, which means inflation is still a problem. We're not there yet. Then there's the reverse repo rate, which also sort of proves the point. So the reverse repo rate is where banks basically borrow assets from government, which basically also proves that there's too much money in the system. So the banks give the government money in exchange for assets, and these assets are like treasury securities, etc. So maybe assets is not the right word, and that is still growing. We're sitting at almost 2.2 trillion now, and it's still going up, which also signals that there's way too much money in the system. And obviously that too much money in the system means inflation's still going to go up. So that's not exactly a bullish sign. And it's also where the money is sitting. If the money is sitting in consumer hands and consumers are thinking that there's still a good reason to spend all their money, then it's a good thing. But it doesn't look like the consumer sentiment is not actually to spend money. At the moment it's to save money. So that's not a good thing. Unemployment is good. That's one of the few things that are actually good. Volatility, it still looks like it's going up since the beginning of the year. It does have a bit of a trend line that basically signals that it's still increasing. So volatility, usually with a bull market, volatility goes down, and with a bear market, volatility goes up. And it's still trending upwards, which sort of tells me that we're still going to be in this bear market for a while. The yield curve, that's a big one. The yield curve. The yield curve, we've obviously gone in March, January, February, March, April. In April, we did go below 0 on the yield curve, and that's usually a big indicator of a recession. But what has happened now is that we've gone away from 0. We went up to 0.4, and now we're trending back to 0 again. We've almost touched it middle of the month, and now, but we're still sitting on 0.1. So we're still very close to 0, which is not a good thing. That almost just like confirms that the recession is imminent. We are going to have a recession soon, so I won't get too optimistic just yet. And those are sort of the things I'm looking at. If you have any other ideas of what to look at to sort of have a bit of a macroeconomic analysis of the markets, can you just drop that in the comments? What else can we look at? These are just sort of the things that I look at. And based on all these things, I don't think we're going to have a bull market anytime soon. I think we're either going to have a bear market, or we're going to run flat for a while until all these things are resolved. Obviously, the oil price is still very, very high. It's come down a bit, but it's still ridiculously high. Obviously, there's the prices of gas. LPG gas is going to go up because of the German shortage of gas. And so there's not a lot of positive indicators in the market. I mean, the only thing we know is that there's too much cash in the market, and inflation is still untamed. So I think we're still in this bear market for a while. I won't get too optimistic just yet. That's my point of view. But anyway, if you want to see more of these videos, or if you like this video, then remember to press the button. If you want to see more, hit subscribe. Until next time, this is Steve, over and out. Ciao.